Good morning, everyone watching live on BAM YouTube. Let me know in the comments where you are tuning in live from. The Hot Sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's Hot Sheet, I will cover an update on housing starts, the 2023 Multifamily Outlook, home price predictions from Zillow and Moody's, and the top 10 markets for first-time home buyers. Today is January 20th. It's a Friday, and the Hot Sheet starts now. Good morning. We're going to go right into these housing starts. We've had really good week in terms of news and information. Very positive. Hit the thumbs up if you've been enjoying the housing news all week. Mortgage rates and mortgage applications. All of these things were positive in the beginning of the week. We even saw builder sentiment go up. You can always search these videos in the live tab on YouTube for the Hot Sheet. It's live every single Monday through Friday. 9:30. This is finishing off the second week of the Hot Sheet. But we're going to get into today here a little bit of news that might not be as positive or very, contradictory to what's going on. All right. So let's start with housing starts. Inventory is all of a sudden becoming an issue again. Yes, nationally, inventory is up year over year, but is it up in the right price ranges? Is it up where we need inventory? Let me know in the comments how you feel about that. Housing starts in the U.S. dropped 1.4% to a seasonally adjusted annualized rate of 1.382 million in December of 2022. Okay, housing starts, of course, are new home starts, new construction, new inventory being introduced into the market. The lowest level in 5 months, but above market forecast of 1.359 million. Starts for units in building with 5 units or more sank 18.9% to 463,000, while those for single family ones jumped 11.3%, to 90,000. This is, and you can find all of our sources and the charts that we're going to be using today all on one link down below. You can get everything on one link. This source in particular, tradingeconomics.com, has a variety of information. So if you're interested, I'd encourage you to go play around. Starts were lower in the Midwest, negative 37.4%, the West, negative 9.5%, and the South, negative 4%, but jumped, this is an outrageous number, jumped 135.6% in the Northeast. Northeast builders are seeing an opportunity in the Northeast. Northeast is one of the markets where we haven't seen prices drop, where inventory is still historically low. So it makes sense there. And listen, there's not a lot of room to build in the Northeast, right? It's not like Arizona or, parts of Florida or parts of Texas where there's land you can continue. It seems like never-ending land to build on, densely populated in the Northeast. So when you have low housing starts and then you start getting some, 135.6% is quite the jump. December marks a fourth consecutive month of falling housing starts, though, pushing the 2022 drop to 3%, first decline since 2009, as rising mortgage rates and inflation weighed on affordability. All right, so here's where it gets interesting. Here's the chart. If you're on YouTube, you can see this chart. You can download everything down below. This shows you from January 2022 to today, the decline of housing starts. You can see in July, it just dropped, dropped significantly in July because of June. We hit almost 8% interest rate, 7% mortgage interest rates. Started to tick up a little bit in August, but continuously just dropping through the end of the year. Here's where it gets interesting. I'm going to go to 25 year. This line at about, let's call it 2000, 2001, we're at the 1.5 million mark. That's probably where we should be seasonally adjusted. We got out of control 2005 with building, 2005 going into 6 and 7, but it hasn't gotten back to that line of 1.5 million since just the beginning of 2020. Then it dropped again, the sharp decline right here. That was COVID. We started building a little bit to try to catch up to demand. And then we fell back below that number, and we are now trending down again. This isn't good for a lot of reasons. Okay. There are obviously there's some people, and we're going to get into some contradictory price predictions here in just a little bit with Moody's and Zillow in terms of pricing. But there are a lot of markets right now where inventory would be highly welcomed. It's one thing for mortgage rates to go to 6%. And that's going to help affordability from 7.5% to 6%. Okay. But what's not going to help affordability is if there are not homes to choose from. And people anywhere within $100,000 range, up or down, of the median prices in their market, if they're competing with 20, 30, 40 offers, they're going to have a hard time getting a value, getting affordability on their home. And interest rates are at 6%. Okay, so stick with me here. I don't know if you're seeing posts like this. Let me know in the comments. Hit the thumbs up button if you're seeing a whole bunch of posts like this. I consider myself a pretty productive agent, but this week I wrote more offers from multiple buyers than I have in the last 2 months, and all have been in multiple offer situations. This Connecticut market is getting wild again. Okay, so we referenced the Northeast, and Northeast has very low inventory. Got it. Okay, let's take a look at another post from an agent. And I'm sure everybody's seeing these or experiencing these if you're an agent yourself. Okay. Danielle Levy says the listing under market value is working again. A friend of mine sent me a screenshot that the realtor is requesting 24-hour irrevocable, and they received 27 offers. Listen, rates going down, in my opinion, can only do so much. It's the inventory issue that we're faced with. And listen, it's not inventory in luxury price points, certainly not inventory in multifamily starts either. We're going to talk about that in just a second. It's inventory where people want to buy single family homes. So that 11% increase that we did see, for housing starts is a positive for the month of January, 11.3% for single family homes to 90,000. That's welcomed right there. I'm sorry, for the month of December. But overall, we're still declining. Year over year, we're still declining. We don't have enough housing starts. Builder confidence finally for the first time is up. We talked about that earlier in the week. Hopefully, with that confidence, we will start to see some more inventory, because that will help affordability more than anything else. There's clearly pent-up demand in that millennial generation, especially. And that's what's going to continue to push up prices more than anything. We can't keep inflating housing prices to the degree that we have the last couple of years, and not have the Fed hold back on some of these rate increases. So it all kind of works together. Okay. And listen, today on Knowledge Brokers podcast, if you're not following that, make sure you go to @Knowledge Brokers podcast. We're putting out the third one today. It'll be up at 2 p.m. Eastern. We're going to go deep on that. If you're an agent, we're going to talk about what you can do to articulate to a seller why they should be listing today. They'll make more money today than they will in April. So make sure you go @Knowledge Brokers podcast on YouTube and check that out. All right. 2023 Multifamily Outlook. All of a sudden you're hearing a lot of, and this is on nowbam.com. You can get this article, put it down in the source link as well. We're hearing a lot of information from people in the multifamily sector where, rents are actually going down right now. There's about to be a whole bunch of new inventory hitting the market. So unlike single family, there's about to be a whole bunch of completions for multifamily. Yardi Matrix released its moderated 2023 multifamily outlook with projections for this year's rent growth, which is expected to return to historical averages. It's been just skyrocketing. Pressure from inflation, interest rates, and an increase in rental inventory will likely cut 2022's rental growth in half. Yardi Matrix released this projection. In 2022, rents in the U.S. increased by 6.4% after peaking near 16% in 2021, the highest rent increases seen in a century. Okay, so they're expecting this to go down to historical average, more normalized. Listen, my projection with all of this new inventory about to hit the market, listen, there's 440,000 new deliveries coming this year in multifamily. You're seeing people now get deals that they didn't get in the multifamily market because they know that when this inventory hits the market, this is investors holding properties, it is going to reduce the value of their multifamily investment. If they have older product, what happens to that when new product is competing? Well, if I'm a renter, I'm going to go to the new product if the rent is comparable, right? So what does that do? If you start now having vacancies on your older multifamily buildings, it's going to reduce the value of that. And we're going to see a stock increase of 2.9%. Those deliveries will be concentrated in fast growing markets like Dallas, Austin, Charlotte, Nashville, and Orlando. Listen, we need more single family inventory. We need more homeowners in America on an affordable rate. Okay. The multifamily stuff is great, but a lot of people have been trying to take advantage of this moment. Okay. If we look at the dichotomy of the current housing market right now, as I'll call it, from multifamily investors to real estate agents, they are saying two totally different things on Facebook and on Twitter. I'll show you this tweet. Okay. Keith Wasserman, who is a LA multifamily investor, says, a lot of price reductions in my inbox. He's somebody who looks for multifamily deals. Jay Pitts, he owns a Remax brokerage in Kentucky. He does deal after, he's a unit machine, this guy, in median price points. Okay, median price points in America. Lots of highest and best and counters in mind is what he replies to Keith. So the dichotomy right now of the housing market, if you're a multifamily investor, you're seeing deals, you're seeing price cuts, you're seeing reductions. If you're a real estate agent dealing with median price points across America with home buyers and home shoppers who want to secure a single family house, you're seeing multiple offers again here in January 2023. You're seeing final and best. You're seeing 20 plus offers in some instances. These are two totally different markets that are happening at the same time. And depending on how dig you deep, you might start to believe, oh, price reductions, market's crashing, or you might start to believe, well, everything's going to go up in price again. If you're looking for median price point, single family homes, you're probably going to be right about that. So I'm not that bullish on multifamily. We need more inventory in single family because we can't see another inflationary rise in prices this year without the Fed doing something dramatic. I don't want to see layoffs. Google announced 12,000 layoffs. Those 12,000 employees are probably going to be okay. They're probably going to get a job very soon. Okay, that we've seen that in the tech industry. They get reemployed very quickly. Okay, they're if you're working for Google, you have an outdated skill. You're very marketable to a lot of businesses. Okay, so we've seen a lot of tech layoffs. We've seen a lot of housing layoffs, but we start to see layoffs across the country, just regular jobs. That's where things are going to get bad. If housing gets inflated again in 2023 because we have no inventory, the Fed's going to do something dramatic, and that worries me quite a bit because I think they might take it a little bit too far. There are still a lot of differing, despite what we just showed you on agents saying multiple offers, going over asking price again, like it's a la spring 2022. There's still a ton of predictions out there that we need to take into consideration that say prices will not go up this year. Okay, so Fortune, Lance Lambert wrote a piece just released this morning, how home prices are expected to shift in over 300 housing markets, according to updated forecasts from Zillow and Moody's. Okay, so you're going to see that there is a real difference between these two forecasts. All right, U.S. Home prices overall fell 2.4% between June and October. Pretty mild. I said yesterday, I'll take a 0 to 5% drop on any of my real estate right now and not think twice about it. I'll sleep very, very nice at night. I bought, way before the increase. The relatively bullish crowd includes Zillow. Okay, so Zillow's bullish, and I personally like that because Zillow is seeing, whoa, look how much traffic is is happening on our website right now. Look how much buyer demand, 28% mortgage application increases. Okay, this is the type of stuff that we're going to be talking about on Knowledge Brokers podcast on how to articulate that to sellers. Relatively bullish crowd includes Zillow. Latest housing forecast produced by Zillow economists has U.S. home values falling just 1.1% between November 22 and November 23. Okay. Meanwhile, the relatively bearish camp includes Moody's. Its forecast says national home prices falling 5.1% between fourth quarter 22 and fourth quarter of 23, peak to trough. Okay. So Moody's 5.1%, not as bearish as Goldman Sachs. We've talked about Goldman Sachs a whole bunch, but when you put these two charts side by side that Lance put together, you see here regional home values expected to shift over the coming year, according to Zillow. You've got a whole bunch of green, which would be an increase in home values. Okay. You see Florida, Zillow is projecting to increase. You see really all of the Southeast projected to increase in home values, according to Zillow. See Arizona looking pretty healthy. Okay. You see some of the Northwest being healthy in terms of home values going up. You could argue I get it, whether that's healthy or not. If you're a home shopper, totally understand. Okay. Looks like Texas down, California down, majority of the Northeast outside of Maine down, according to Zillow over the next year. But Zillow, in reference in the article, very optimistic. Okay. Let's go to the Moody's chart. Here it is. Moody's has absolutely no green in it whatsoever. You can't find any green on this map. Florida, very red. And I'm not talking about politics. Arizona, California, very red. Northeast, all red. Everywhere, it's red. So they're saying 0 to negative 10%. In basically every single market. Moody's is projecting a negative 5.1% drop in home values. Listen, we don't get inventory. I don't see it happening. I just don't. Let me know in the comments how you feel. We need inventory in almost every single market. And I'm not talking luxury inventory. I'm talking about the inventory that millennial home shoppers, majority of millennial home shoppers are buying. I showed the economics website. It is tradingeconomics.com earlier. Okay. Logan Mochami from Housing Wire put out a tweet using that website to just show how inventory is so low right now, all things considered. Here's the tweet. It's not 2007. Back then, over 4,000 active listings. Today, 4 million active listings. Today, near 1 million. Look at that straight line. It's just been dropping and dropping and dropping. It's why those housing starts that we talked about at the beginning are so critical to the health of affordability. And, builders have a whole, if there was a builder on this right now, they'd be saying, Byron, well, I can't build an affordable house. Talk to, the restrictions in the permitting process and building material and all that. And I get it. Right. Okay. Realtor.com, they've released their 10 markets for first-time home buyers in 2023. A lot of first-time home buyers, a lot of millennials getting priced out. Just talked about all that, priced out of all these different markets. So where are the opportunities, according to Realtor.com? This is on nowbam.com, and we'll link that up here in our downloadable source and chart link. Realtor.com shared its forecast for the top 10 markets for first-time home buyers in 2023. Okay, here they are, top 10 markets for first-time home buyers in 2023. Portsmouth, Virginia. DeForest, Wisconsin. Windsor Locks, Connecticut. Gloucester City, New Jersey. Moore, Oklahoma. Magna, Utah. Eggertsville, New York. Watervliet, New York. Mattydale, New York. a lot of New York. Somersworth, New Hampshire. What do the this year's top 10 markets have? They have robust job markets, short commute times, abundance of places to eat and drink, a younger population, affordability, more homes to choose from. You might be thinking, where the heck are some of these places? So they're a little bit outside of a main metro area. You've got to drive probably 45 minutes to anything that resembles city life from these locations. But that's why people are getting an affordable deal out there. There are 20, 30 offers happening in prime locations on properties near the median price point. So it makes sense that first-time homebuyers got to go a little bit further out. And Realtor.com, I think they're probably right. These types of locations that are a little bit further out are going to be where the deals are available for first-time homebuyers. Daniel Hale, Realtor.com chief economist, says the housing market will continue to be challenging for first-time buyers in the coming years, but there's a bit of flexibility where they live. There are markets where young buyers can find not just relatively affordable home, but a neighborhood that offers a mix of economic opportunity and lifestyle amenities. Affordability always a consideration for first-time homebuyers, but it's important that you're settling in a location that's got all the qualities, place to live that you love, and all of that. So totally makes sense to me. I think if you're tracking your local market or advising buyers, you're probably doing the same thing, right? Hey, maybe we need to look 10, 15 minutes outside so we don't get into an issue where you're overpaying in a near peak market at a 6% interest rate. I think a good buyer advisor is certainly going to be having those conversations often and always with their buyers. Okay. Really hope, please let me know in the comments. If you've been following along the first 2 weeks of the hot sheet, let me know what your feedback is. Have you been enjoying the hot sheet? What's your feedback? What could we do? Should we do some type of Q&A at the end of these shows? Okay. There's a lot of different things we can do. We're doing the daily download sheet for the charts and the sources, but what else can we do to make it better? Let's touch on the 10-year. Oh, by the way, if you watched yesterday, my prediction, I think I said, for the 30-year fixed yesterday, I think I said it'll probably come in around 6.1. It came in at 6.11. I think I nailed that one. So yeah, 6.11 for yesterday's, because we did see the 10-year tick up just a little bit yesterday after it dropping on January 18th, and we had the 6.04. So we're at 6.11 for 30-year fixed mortgage rates. And right now the 10-year is ticking up just a little. It's not over 3.5. So that's good news. We're at 3.452. Watch that 10-year here throughout the day to give you an indication on what's going to happen with the 30-year rate. Today, 2 p.m. Eastern on @Knowledge Brokers podcast, brand new YouTube channel. Myself, Tom Toole, we're going to go deep on this information, but how to specifically articulate it to home sellers to get them off the fence to list now. Listen, agents, you're on the front lines of this thing. The industry needs more inventory. Hope you guys enjoyed. Have a great weekend, and we'll see you back here Monday, 9:30 a.m. on the hot sheet.